Good afternoon, everybody. Welcome to our October series of two webinars, our second one today for the fixed income strategies. Obviously, there's a lot to talk about given what's transpired, I guess, in the last month or so with regards to the Chinese property market. And so we're going to do a little bit of a deep dive into that sector today for everyone's benefit. So for those who don't know me, my name is Jonathan Wu. I'm the Chief Investment Specialist and Executive Director for Prem China Funds Management. And so it is with my pleasure today to run you through our current holdings and also have something quite special to share with everybody on the line today. Just monitoring the people on the webinar today. I see a couple of fresh faces and names, so thank you very much. And for those of you that have recently added us to your model portfolios and SMAs, we also thank you for your support well into the future. A couple of housekeeping issues first to kick things off. Today's webinar will be recorded like all our regular ones are. And after this webinar, you will receive a link with a copy of the recording that you can share with your colleagues and even clients if you wish. As well as that, you'll receive a copy of the slides that I'm going to put up as well. And I'm just going to put that up now here. I think everyone can see that now. So a few questions, obviously, with the new DDO regime that's just come into play. We've issued our TMDs as of the 5th of October. We're pleased to announce that there is no distribution conditions on any of our strategies, as well as that we all our funds sit in the satellite category, hence not receiving more than 25% of a client's portfolios. So let's kick things off. I do note that there are some direct clients on today's line. So what is being presented today is of a general information only. And if you require financial advice, please seek that from your professional financial advisor. Sorry. Okay. So just to keep everyone updated. Value Partners now manages around $11 billion US, and that's split across fixed income and equities mostly, with about $4 billion on the fixed income side. We are a relative value manager, so we do look for contrarian ideas, and today I will be sharing a live example of a contrarian idea with everybody. And I guess what our fundamental value add to all of you on the line today is that we have 70 members in our investment team, 11 of which is in the fixed income space. And what we are attempting to do is that we are trying to find things that are under researched by the market. And in the case of the fixed income strategies that we offer, one of the showcase, I guess, ideals of our investment philosophy is that we don't trust credit rating agencies and the value of the reports that they provide, which has then actually been able to allow us to drive returns for your investors over the last 10 years. And so just like on the equity side, we are looking for the 3 R's. We're looking for the right business run by the right people at the right price. And we have a true bottom-up picking philosophy. We don't care what the benchmark holds, especially at this point of the market. Certainly it is very much point to advisors and asset consultants alike that going into passive strategies or funds that have low tracking errors or do need to be specifically overweight or underweight a particular sector or otherwise is very difficult for them to add value as the level of volatility increases. So we've got a very proactive management strategy with regards to the way the portfolios are run, and we're constantly looking for new data points to see if our theses are correct, which again translates to the performance that you've seen. So this is an updated view of the team. It's only growing. There's another 2 spaces that Gordon wants to fill in the next 12 months, of which at least one of them will be in the new research and strategy group. The new research and strategy group only further enhances our research capabilities in the region. And the sort of the key role for the research and strategy team is to identify sectors which look undervalued. But not only that, but to also deliver to the portfolio management team, headed by the DCIO Edwin Cam, to then look at those underlying bonds. So, for example, in the last 12 months, Anna would have seen the BRI index or the shipping index go up significantly. She would have come up with an idea and said, this looks like quite an interesting area to look at. And then she'd drill down further and look for half a dozen to a dozen names, which she would then pass on to the portfolio manager team and say, you guys should have a closer look at this sector. And that's, again, translated to more ideas that have flown through to our portfolio to drive those coupons and obviously capital gains. So the strategy is primarily mixed, predominantly high yield. It always has been. We had up to a 20% position in investment grade debt just coming out of COVID, because that was a great place for us to basically de-risk the portfolio, but at the same time add value in a more safe way, or a less volatile way, I guess. And then obviously those bonds have now gotten pretty close to $100. We've rotated out of those, again, trying to find bonds that are trading at less than $100. So we're looking at a target yield for your investors or investors on the line of 6% cash in hand per year. We have not failed to do that in the 10 years, which means that we now have 40 observable quarters of distributions, of which there hasn't been a single quarter that has paid less than 150 basis points. So we're looking for those bonds paying at least 6%, and then sort of stacking on top of that, ensuring that the liquidity is there. That's very, very important. And sort of looking within that universe, we actively monitor between 800 to 1,000 bonds that covers about 300 issuers right across continental Asia. So for those of you that have followed us for a while, last year during COVID, we made a call on Israeli sovereign debt. We took part in a primary issuance there in May of 2020. And that's the most Western country that we can participate in that falls within the geographical bounds of continental Asia. And then the most eastern side that we can have allocation to is actually Japan. So, the culmination of our strategies put together, as you see on the screen here, is that every bond that we are looking at investing in is all focused around what are we trying to achieve. So when you see in this top right-hand corner, the scorecard is out of 5, and it's the culmination of these 3 critical components, which is made up of company fundamentals, the investment risk-reward profile, as well as the market liquidity. And what you see here is that, if we take the example here, what you see here is in terms of strategy, before the analyst or the portfolio manager makes a decision on investing or not in a particular bond, he or she needs to decide why we're buying it. Are we buying it for a tactical trade? Are we buying it for yield? Or are we buying it for longer term capital gain? So those are the 3 strategies that we participate in. And depending on which strategy it is, for example, let's say tactical trading, well, market liquidity and momentum are critical to getting in and out of a particular bond. Whereas long-term capital gain or income, the liquidity and momentum score is less important in an overall sense. Now, this chart shows everyone, the challenge of finding good bond investments to get into. And the fact of the matter is, in Australia, we aren't actually as good as our friends across the ditch in New Zealand. I see a number of our New Zealand friends are on the line today at evaluating bond investments, because simply put, we are a dividend country in Australia. We also have the power of franking credits, and therefore bonds isn't an area that we have delved into too much. But the issue is that traditional bond funds in an environment where rates are 0 are fundamentally and technically challenged, because you can't actually squeeze any more capital gains out of bonds when rates are 0. So for the foreseeable future, you see how adamant central bankers are in not raising rates. They're using every trick in the book. They are effectively manipulating the inflation figures in order to meet their criteria of not having to increase interest rates at a fast rate or right now. Now, that obviously runs the risk that if inflation readings and inflation prints continue to be this high, we might be behind the 8 ball. But if we're then behind the 8 ball and rates then go up really quickly, the risk is that the capital losses on traditional bond funds is going to be very, very severe. I'm going to come back to that in a minute and compare sort of where we sit on Australian government bonds versus global government bonds versus what we're offering, and that will give you obviously another better context. So what I want to dig a little bit deeper into today is around the China property sector, and that's been the biggest talking point for the better part of 2 months. As I said, I have something very special to show you because I fought with compliance for quite a while to actually bring this to you, simply because it is a live trade as of today. So I can talk about it, but I haven't been able to put any words behind it in terms of putting pen to paper solely from a compliance perspective. So let's talk about, for a minute, what was the trigger of the China property sector? And I'm also going to discuss the point of why we believe that the China property situation and the debt situation inside China at the moment is not China's Lehman moment. So one of the things that a lot of people talk about in terms of China's problems. So China's got an authoritarian government. They are stamping down and attacking every sector that they can find. They're trying to destroy capitalism. Fundamentally, what people don't or very much forget about is no one talks about the actual problem that's in China. The fundamental problem that drives the government policy changes that we have seen over the last quarter, effectively since the after-school tutoring sector was decimated back in July. The fundamental problem China has, and once you understand this, everything that happens into the future becomes a lot more clear, is that China is facing a birth rate problem. Its birth rate is about 1.2 children per couple, and that's a very, very low reproduction rate. Now that generates a lot of problems because in China, you've got 3 key social problems that impacts that disposable income, which then impacts parents not willing to have more than 1 child or have no children. In actual fact. And the 3 problems is the cost of education, vis-a-vis the cost of after-school tutoring, the cost of property, and traditionally there is no institutionalized aged care sector like we see in Western democracies. Why? Because in Asian culture, you would have up to 4 generations of a family sit or live together under one household. And the problem is, if you are one of those people, families having 4 generations, your great-grandparents and your grandparents are retired, they don't generate any income, and effectively you're relying on the lower 2 generations, of which the lowest generation doesn't generate a lot of income because they're kids, or they may be young adults, that you have this fundamental problem of not having enough money to spend. So if the cost of housing, just repeating that, if the cost of housing is high, if the cost of after-school education is high, and there is no institutionalized aged care sector, these 3 things impact disposable income levels, which impact consumption, which then impacts birth rates. So with the property sector, the key thing that everyone needs to understand is that this is not a new thing. And China last year effectively conceded in an indirect way that all the demand side regulation that they put in or reform wasn't tipping the scales in terms of the demand for property. So if they've now worked out that they can't control the demand side of things, why don't they try to put the brakes on the supply side, which is where these 3 red line rules have come into play. So if I bring the screen back up again, the 3 red lines are effectively now government mandated debt covenant rules, which are the following 3. You can't have a liability asset ratio excluding advance receipts. So advance receipts is prepayments of properties of less than 70%. Okay, net gearing ratio has to be less than 100%, and your cash to short-term debt ratio has to be more than 1 times. So to give you the example of someone like Evergrande, well, Evergrande had crossed all 3 red lines. Fantasia, which is the other one that's recently defaulted, and that's the one that we've now invested in, after sort of basically a week before they defaulted, with the anticipation that default was going to happen. This is the impact of the 3 red lines. Now, the thing is, this 3 red line rule was actually implemented in August of last year. It's not something new. And it is something that is going to still have further ramifications for the years to come. Because the Chinese government has realized the sustainability of cheap debt to property developers for the last 20 years has generated fundamentally a lot of growth. It's generated wealth for the Chinese populace, but it's also caused social imbalances. So if we then go back and consider this issue around the Chinese intervention of their policies on society, is the question, does China let its citizens make money? Okay, so are they fundamentally going backwards and saying, we're moving away from capitalism, or is there another rationale behind it? And the way we like to look at it is we call it adjusted capitalism. And adjusted capitalism works something like this. If you are making profit, but you aren't creating a social problem or a social distortion, go ahead. Shipping companies, bike companies, semiconductors, right? Car rental companies. All these companies make supernormal profits, but they don't cause a social problem. So if they don't cause a social problem, why would the government intervene? And shipping companies is probably the best example of that. So if, from our perspective, when we're considering an investment thesis, whether it be for equities or fixed income, the key thing for us is whether or not the companies that are making the supernormal profits create societal problems, like Alibaba does, okay? Which is why we haven't been in Alibaba since October, November last year, yet a lot of global managers are still in there. They can't see through the structural headwinds. They're pricing Alibaba in the same way that they're pricing most tech companies in the United States, saying it's cheap. We think it's cheap, but we think it's a value trap. And so with all the future quarter where we expect there's going to be more regulation coming down the line, if you understand, if the government regulation is trying to get the birth rate up, it makes sense. And all the policies are coming off that vein. So why implement the 3 red line policy? So there are 5 key reasons. One is to control house prices. Okay, so the government is mindful that the market rise in house prices over the last 15, 20 years has been quite a lot, which has made property unaffordable for some cities. Okay. 2, manage the land market. Now, the way that the Chinese land market, for those of you that follow it, is on a system whereby the government sells the land, and the local governments are the ones that are in charge of selling the lands. Okay, if local governments are pillaging developers by selling land at a very, very high price, this then obviously feeds into home price growth, because the developer then needs to increase their selling price of a finished good, and then that pushes prices up even further. Okay, so this is going to be a balance between local governments and developers, ensuring property prices of new properties don't go up too fast. 3 is to ration the credit to the real estate sector. Too much cheap debt for too long. Okay, it wasn't the wrong policy 20 years ago when the government needed to find a new growth driver, right? But it now has to be rebalanced across the economy. 4, lower cyclicality. So the cyclical nature of the property market for the last 20 years has caused a lot of what we like to call boom and bust cycles, or traditionally what people call boom and bust cycles. This is a problem because it creates instability at different points in the economic cycle, which may not be linked to the property cycle. So if you rein in debt, which means that developers can't overextend themselves, which means that the number of developments on hand at any given time is decreased, the earnings forecast that we've plugged in for property developers going forward become more stable. Now, how does that then lead to an investment decision? For us, we don't hold any property developers in our equity funds, but it means that going forward, there's going to be more stability in the Chinese property market, and it's going to come in 2 forms. If there is marketed material levels of stability in the Chinese property market, bond yields might go down, because as you're buying into something that's more stable, the yields are going to become lower, right? But at the same time, we feel more comfortable going back potentially, right, depending on market conditions, more heavily into the property sector. Now, despite the first four reasons, remember that the Chinese government, by implementing the three red lines, reflects and recognizes the structural importance of the property sector. They can't go and destroy it, okay? So remember that the eye is on the prize and the government wants to stabilize the property market, not to destroy it. There is no benefit for anyone to destroy the property market in China. And after the government implemented the three red line rules, what you can see here after 2020, there are now over 90% of developers, 96% in fact, that are either completely green, meaning they breach none of the three red lines, or 58%, which reflects that only one of them breaches the three red line rule. And the thing is, China property year to date, contracted sales continue to grow. It's nothing different. And nothing's really changed from that perspective, right? So the demand for property is still high. The risk is whether or not the government has the ability on delivering the property as someone like Evergrande is going to go down. And we've made it really clear, even from 2 months ago, that our belief is that there is no rational reason why the government will want Evergrande to survive. It is not in their interest to let it survive, because if you remove Evergrande from the scenario and overextension of debt, too many projects on the run at the same time, sort of then diversifying those across the existing remaining developers in the market, that becomes a very, very good way to normalize the profits across the sector. So you'll see a very, very interesting line chart here. Compliance has made it very clear to me that I can tell you where we bought, and then that is about it with regards to Fantasia. I can't write anything more on the slides, but I am going to talk about this case and the investment thesis now. Now, to be clear, we have no Evergrande in the portfolio, bonds or equity, before and after this latest default. We think Evergrande is, on a risk-reward basis, is too dangerous to go in. We do believe, though, that if you have the appetite to go through the restructuring, you would make good money on China Evergrande, but this fund is not targeting that. So for those of you that have followed us for a while, you'll know that we allocate up to 6 to 7% of the portfolio in what we call special situations. Special situations don't necessarily mean bonds that have default or about to default. They could simply be market distortions, like the Israeli sovereign debt that we bought in May last year. It was just free money on the table to make 7% on the holding. It was a 2% position to make 7% in a week. So let's talk about Fantasia. Fantasia is a much smaller developer to Evergrande. So to give you the context on the debt size, remember that the big numbers that the Western media loves to put out around Evergrande's debt size of about $300 billion US. And even then, I'm going to talk about why China Evergrande is not Lehman's moment, because there's a fundamental difference between Evergrande and the GFC. But let's talk about Fantasia for the time being. So China Evergrande has about $300 billion US worth of debt. Fantasia is about $8 billion. And in actual fact, Fantasia has just over $4 billion US in cash on hand. So the net debt position is $4 billion. At the same time, if you measure them against the three red lines, they breach 2 of the 3. So it's not quite as bad as China Evergrande. Now, note that we weren't interested in this bond. We weren't interested in this bond prior to the before all this latest round of volatility came in, but this started looking very interesting to us as the bond price started to fall. So see how deeply the price has fallen over the course of the 3 months. It's basically gone from $90-ish down to now where it sits yesterday or the day before at about $22. Now, for those of you that look at bond markets and bond funds, for a bond to fall from $10 to $20, you are effectively pricing in Armageddon. So to contextualize this, for those of you that were in the industry during the Euro debt crisis of the early 2010s, Greek sovereign debt, where they were on the brink fell from about $100 to about 30, and that was already cataclysmic. So when we look at these sort of special situations, we look at it from the perspective of, is this a good risk reward? Now, I want to make it really clear that this position in our fund makes up a grand total of 15 basis points, 1-5. We bought this bond on the 24th of September with the anticipation that they would most likely default on their 2021 bonds, which was due for repayment on the 4th of October. That is why you can see at the beginning of October, see just after we bought, the price went from 35 down to 22. So in the context of our entire fund, this is tiny, but we think the risk reward looks looks interesting for us to look deeper into. We've seen a lot of bonds trade hands between private investors and private banks to hedge funds. So hedge funds are now swirling around this because they believe that they can make money through a restructuring. What are we aiming for? We're aiming for a restructuring. Again, we think the way that we're calculating this is that if a restructure comes for the 2021 bonds, and right now there is no haircuts, there may be a small cut on the coupon, but there's no haircut on the principal as it stands now. If you restructure it, then the 2022 bonds, which matures in May next year, should jump up to at least the 40s. And if they complete an asset disposal exercise, our numbers show us that it should go back up to the 50s. That's when we'd look to exit. We've also priced in the worst case scenario in our opinion and in our thesis that if everything stays the same now and it's going to linger on for restructuring for many months on the 2021 bonds that have now been defaulted on, then it'll probably trade about 30s. And the thing about Fantasia in its business model is that A, it's a lot smaller. 2, they have a lot of land and development going on the Greater Bay Area. So the Greater Bay Area is basically the triangulated area between Hong Kong, Shenzhen, and Macau. And the government is, as of about 3 years ago, has dedicated a lot of resources in the Greater Bay Area because that's where a lot of that GDP growth is. So for those of you that think that China doesn't care about Hong Kong, no. It very much cares about Hong Kong because it knows it is a critical financial center going forward. So a lot of those overdevelopments in land value that can be unlocked by Fantasia through an asset disposal exercise is very, very strong. And therefore, we find this to be a very interesting trade for us. As I said, now you understand why I haven't been able to put it on paper, because it is literally a live trade as it stands today. So then let's delve into the question of why is Evergrande not China's Lehman moment? Well, the first thing is that unlike subprime mortgages, the market has talked about China's debt issues for the last 10 to 15 years. It is not something new and it's not something unknown. The Lehman's moment was caused by what? Not debt in of itself, but the derivatives of that debt, the repackaging of that debt. Evergrande doesn't have this problem, right? Furthermore, the government actually intervened last year with the introduction of the 3 red line rule. Fantasia and Evergrande would not be where it is today if the government did not introduce those rules. Because the fact of the matter is that by the introduction of those rules, the lenders that are in the market know these companies are overextending themselves by the new debt covenant lines the government has introduced and said, well, we sort of need to step back a bit. We don't want to be the lenders in the market, whether it be bonds or actual direct bank debt, that is extending these companies even more and more to make it even more worse. Okay. Then at the same time, Evergrande's issue is liquidity vis-a-vis people not willing to roll over their debt or lend them more money. Not a systemic financial system problem. The GFC was a systemic financial system problem triggered by the United States. Okay, so the default of Evergrande's bonds in of itself isn't likely to trigger a financial crisis at either the national level, let alone a global financial crisis. And we've always said since September, never underestimate the power of the Chinese government to step in and create an orderly completion of this debt to maturity. And the thing is, that even if you consider everything in China is big because you've got 1.3 billion people. But if the total liabilities of Evergrande is 300 billion, and yes, it is a very big number, it only accounts for 60 basis points of total bank credit in China. And remember that Evergrande's major liabilities, when you actually look through its balance sheet, is trade payables, so vis-a-vis their suppliers, which is likely to be restructured, okay? So again, that final point, unlike the GFC, there's no derivatives based on Evergrande's bonds. China doesn't have a derivative problem as it stands. So going back to the key question of should you be buying bonds now? Well, what we're offering is two ways to win. We're offering a way to win vis-a-vis a strong yield of 7.25% with 5% capital gains on a per annum basis for the next 2-ish years to get you back the $100. If you're going to clients now, or you still have clients in government bond funds, this is what you're paying. You have to make it very clear, as I say, month in, month out, and we just update these figures, that if your clients are in government bond funds, you need to express to them that they are paying $113 in order for them to get $100 back in 7 years. And in the case of international government bonds, you have to tell them that they're paying $109 to get $100 back in around 9 years' time. And when you net all that off, the yield to maturity on both the Aussie and international bonds is about 100 basis points. We're looking at about 12 times that high. Now, that doesn't mean it's more volatile. It just means we're in a market that no one else wants to be in, which is also really good from a diversification perspective, because as we've done a lot of blending exercises for advisors, those blending exercises have shown that basically we are the guys that provide that higher level of yield, but it actually diversifies the type of volatility that you get across your defensive asset allocation. So because of what happened in September, which is an event that's not quite in the same league as March of 2020 with the COVID liquidity crisis, the fund fell about 2.5% net of fees for the month of September. So again, no surprises there, but it has then caused the yield to maturity to go up about 110 basis points or so over the course of the month. So which means that, again, what we're trying to sort of speak to you guys about is when you see these two numbers have a wider gap, it means that the opportunities for capital gains become larger. Now, remember, the other way around is really bad because it means a larger capacity for capital losses. So like you saw in the previous slide, if your yield to maturity is lower than your cash yield, which is what you're getting in Aussie and international government bonds, then you have to look at alternatives. Are there alternatives other than us? Yes, there is, right? But those alternatives blend very well with us because we actually kick out the solid, very consistent distributions throughout time. You also see that our sector exposure hasn't changed too much over the course of the last couple of months. We're still remaining very low allocation to real estate. Remember that 65% of the market in Asian credit is real estate, so we are significantly underweight. And those have been, at the expense of transportation, materials, and utilities are the three sectors that have become a material presence in our portfolio. And further to that, what you also see is that compared to 12 months ago, the amount of investment grade in our portfolio has fallen by about half. So between A and BBB debt, it's around 9% of the portfolio. And we are quite heavily hedged at the moment at around 80%. Against the US dollar. So remember, all our bonds are offshore, so it's all hard currency in US dollars. We don't tinker around. There are a number of strategies that play in local currency. We think that generates a lot more underlying volatility that clients don't really need to be exposed to. And as well as that, you also deal in jurisdictions and local jurisdictions where you may have issues getting back your money, especially if you're an emerging market debt. So that's why by the combining what we've done there, you can see that annualized volatility is still kept below 6% because our targeted volatility over the long term is 600 to 700 basis points. But in the first 10 years, we've managed to keep it under 600 because of Gordon's ability to tailor the level of hedging depending on overall market conditions. So for those already invested, we've paid our standard 30 September distribution of 1.5%. That's after the bullet that we paid at the end of the June financial year of 4%, which means we totally paid out just under 9% in distributions for the financial year. So investors have been very, very happy with that. And this is where we stand now at the moment in terms of the split between volatility and annualized return. And I always remind everybody that what you see on this chart is backward looking. This is 10 years worth, or 10 years and 1 month, actually. We just turned 10. 10 years and 1 month worth of track record for all these funds. And this is the culmination of an environment that 10 years ago, interest rates were fundamentally a lot lower than where they are today. And so going forward, it is literally impossible for these funds to continue to perform the way they have had in the last 10 years. And so recently, and next week, I'm joining a dealer group investment forum that is literally now have turned its head on the way that they're thinking about income and saying we need to actually throw out the term capital stable income, because that doesn't actually exist anymore. Capital stable income can't exist if interest rates have only one direction to go, which is up, which means you are going to cop capital losses even in the most conservative of strategies. So our best and worst periods, as you can see on the screen here, over the 10-year period, our worst 3 months was COVID. Obviously, our worst 3 years was still the period including COVID, and that was 4.2% per annum net of fees for 3 years. So now that we've got our 10-year track record, obviously because of what happened in September, we've fallen out of favor on the year-to-date or the 1-year figures. But again, we're looking at this on a long-term basis, and we have proven our worth through many, many crises over the last, or crises, should I say, over the last 10 years. And our upside downside capture, even inclusive of what we saw in September, over the 5 years, we have a 91% upside capture and a 39% downside capture against Barclays Global Ag, which is where people benchmark the strategy against. So you can see here, there's my contact details, and I should have put Derek's. I seem to have forgotten somehow for this. Yesterday we had it, but please feel free to reach out to us if you've got any more questions on the strategy. And within the presentations, we also contain our TMD links, which you can access through here. So I see that no questions have popped up, and I note that I am a little bit over time. Thank you very much for your time, ladies and gentlemen on the line. Thank you very much for your support, as I said, and I wish everyone a rest of a lovely afternoon. Thank you.